Working on the formulas for Hasbro, that is the liability and equity part of the balance sheet. And we are skipping over, for right now, the short-term borrowings. We're going to do that in class. And in general, I would do that last. It is a plug figure to help balance on the liability equity side. And on the, if you recall, on the asset side, we have cash as a plug that again, typically would leave that blank and do at the end. All right, so we'll jump down to current portion of long-term debt. So that's the additional assumptions. And I've already got that. This is here on our split screen. So here's the additional assumptions down on line row 146, and just a quick glance at the 10K in that regard. And I've got some I've basically bookmarked within the. Let's see. Here we go. All right. So here it shows. It's on page 59. Long-term debt. Payments due by fiscal year, so $350 in 2017, 0 up until 2021. So that's where those numbers have coming from. So let's get back up here. So we'll just do equal 350. All right, leave that relative. Okay. And accounts payable percentage of cost of goods sold. So we'll just calculate that right quick. Okay, I'm gonna, just in case we have another one, I'm not sure if there's anything else that's cost of goods sold, probably not. And that's up toward the top here. Again, same thing as cost of sales, and we'll lock in the 10 there. All right, just in case we want to copy it somewhere. It's probably not in this case, but let's make sure that looks okay. All right, so we got the D locked in. And we got the 10 locked in because cost of sales is always in row 10. All right, if we were need to copy it other than just across. All right, here we got percentage of sales. We'll just go up here and grab one of these for that. And let's check it, make sure it looks okay. All right. And total current, use a sum. Pick up those 4 items. I'll just back up on that right quick, see if you want to look at it. Okay, long-term debt. So let's see additional assumptions. So let's go down here and see what we have on long-term debt. Okay, we've got current portion, and then we've got issuance, which is assumed to be 0. We could change that if we'd like to, but let's build this with that in mind. So it'd be last year's figure minus the current portion of long-term debt, and then add if there's any new issuance. All right, and just let you look at that right quick if you want to. Okay, other liabilities, they're fixed. 4 on that. Okay, and then total liabilities, we would sum the 3 items above there. Okay, and again, it's okay for right now that short-term borrowings are empty. It's being counted as 0 in this calculation, but is included in the formulas. Okay, redeemable interest fixed. I'll save myself a little bit of time. We can just lock in the D there, right? Okay, and I'll just copy that, and we can make sure it's correct. Shortcut for copy what's above is Control D. Okay, additional paid-in capital. This is prior year seasoned equity offering. See additional assumptions, and we are taking a little shortcut here. This is shows up better elsewhere in terms of this little box here. This is a data validation using this as a message. So it says, for simplicity, we are assuming that any seasoned equity offering would be reflected in total and additional paid-in capital. However, accounting rules require that SEO proceeds be reflected also in the treasury stock. Okay, so at least typically anyway. But we're going to do it all to additional paid-in capital, so we're taking a little bit of a shortcut there. All right, so okay, we got previous year plus any seasoned equity offering, and that's down here, row 159. Okay, right now it's 0, and we could change it if we elect to later on as we're working on these. All right, tenders, we're doing that in class, so we'll skip over that. Accumulate other comprehensive earnings. And it's actually a loss, as you notice here. So another little pop-up. Combining stock-based compensation and other gains. So stock-based compensation, typically, as say down here, not fully visible. Accounting rules call for stock-based compensation changes to be reflected actually other places, but that would be typically in your additional paid-in capital and possibly the treasury stock. But for simplicity, we're going to combine the stock-based compensation, have a hard time estimating what that's going to be actually, and the other gain or loss. And other gain or loss would be like for foreign exchange, that is if you've got overseas operations, for example. Okay, so let's jump back over here, and it says take prior year plus other. Okay, and we're down here, okay, for the other. All right, leave those relative. Okay, treasury stock will equal the prior year plus stock repurchases, and that is where right here. Okay, all right, and we just had some discussion and the assumptions about where this figure actually comes from in terms of assumptions. All right, so total equity, we would take common stock at par plus additional paid-in capital plus retained earnings plus, notice how it's listed, earnings. So negative indicates that it's actually a loss, so we treat it as a positive, and that is to add. Okay, so plus that. And we would subtract, however, the treasury stock. We're showing it as a positive number, and treasury stock actually reduces your common equity, your book value of equity. All right, and then our total would be equal to, I'll just use a sum here. All right, so we got our total liabilities. The redeemable controlling interest is a separate figure, so we'll pick it up and then put a comment in there, and then our total shareholders' equity, currently shown as a negative. That's because we have left out the retained earnings, which is, you notice, a big figure in general. Okay, so I'll make it positive. Now, that being said, on occasion you will run across companies that have a negative book value of equity. All right, so we got 318 for that. And we can go ahead and copy these over if you'd like to. Do keep in mind it's easy to make a mistake in terms of inserting or making things a fixed reference. You know, for example, you know, that make sure we got our dollar signs there. So you may want to check your work in that regard when we get finished.